All right, welcome back to the channel. So today is the first attempt at a live stream slash stock analysis. So I threw a poll out there, and I got a good amount of responses, and a decent amount of people said, you know what, go for it, do the live stream analysis, keep the format, and see how it goes. So that's what we're gonna do today. Today we are gonna be checking out Google, googly my oogly, and let's go ahead and dive on into it. If you guys have questions or comments, throw them in the comment section, obviously, and then afterwards we can do a little bit of Q&A, maybe run some different scenarios and whatnot. And I'm just going to go through Google real quick, the latest earnings and what I'm thinking about it. So 5-year chart. Yeah, we're putting into double top. It's a reverse dinosaur double top right now. So be aware. So they released earnings, what was it, last week, a couple days ago, and we had a nice little pullback from about 153 down into the low 140s, and bounced back a little bit since then. But over the 5-year, it has done really good compared to the SPY. We can see the SPY has done about 12.6% KOR, and Google has done about 20.46%. So if it did so good in the past, then it must be a buy, right? No, not really at all. Growth rates over the 5-year is about a 17.5% average growth rate on revenue. Net income is about 19.15. EBIT is about 19.68. Free cash flow growth over the last 5 years has been around 24.93% average. Operating cash flow 16.23% average. And they have bought back, let's see, net of dilution, buybacks, the share count has decreased on average about 1.99% per year. On the multiples front, the market is usually pricing this right around a 4 to 5% yield. So around 4% yield on the bottom line in the 5-year average. Operating cash flow yield around 5.94 or 6 average over the last 5 years. Currently, it's trading about 4.12 or 11 on the LTM basis for net yield. EBIT's about 4.78, free cash flow 3.87, and operating cash flow yield about 5.67. So it's kind of trading in line with historical multiples. On a forward-looking basis, from the data that I'm gathering, it's trading at about 5.32% on a forward-looking basis. So there we go for the brief intro and the brief look at the 5-year chart. And let's go ahead and dive into the press release. I will have these. They should be linked in the description. So if you guys want links to this stuff in the description, check it out. And let's see, where's the press release first? Let's go over here. Actually, well, first, let's say they missed, apparently. According to Earnings Whispers, they missed, which I don't really get, because it says they missed. They reported 1.64 EPS, and the consensus was 160. So that's actually a beat from the consensus. But the Earnings Whispers consensus was 1.68. So they missed. Missed bottom line, but they beat top line. Consensus was about 85.26 billion, and they put in 86.31, and that is on a quarterly basis, isn't it? Yeah, I think that's the quarterly basis. Dang, that's a lot. That's a lot of revenue in one quarter. Dang, that's insane. So anyway, let's get into the press release. So here we can see press release. Overall revenues, they're up from 2022 full year to 2023 full year was about 9%. So a little bit of growth there. I believe net income was up like 23% or something like that, though. So like a fairly large increase in net income. So had a little bit of margin expansion there, most likely. Now on a quarter-over-quarter basis, for Q4 2023 versus 2022, it did look a little bit better, about 13% growth on a quarter-over-quarter on a yearly basis. I don't know. So something like that. So margins for Q4 2023 were 27% versus 24%. Yearly margins were 27% versus 26%. So margins a little bit better. And diluted EPS for 2022 Q4 was 105, and 2023 Q4 was 164. On a yearly basis, we had 456 in 2022 and 580 in 2023. So something I want to check out specifically is the segment breakdown of their different revenue segments. So we see Google search and other, and this was kind of the big takeaway. Still better than VT. Let's go. Actually, you know what? Actually, Google's international revenue has been expanding on a percentage basis compared to their US revenue base. So maybe it's an international stock, So anyway, Google search and other is up to about 48 compared to 42.6 year prior. YouTube ads, not like a drastic amount of growth. 7.9 to 9.2, Google Network 8.4 to 8.2, but we get into the subscriptions, and that's where they've been seeing a lot of their growth. Is kind of in their subscription model, at least for YouTube. Like a lot of their growth in YouTube has been skewed into like YouTube Premium and things like that. So the monetization of YouTube and YouTube Premium has been boosting that Google subscriptions segment of the revenue. And we can see that that had a really good increase. Shoot, what was it, like 26, 27%, something like that? I don't know. Rough numbers, but 8.7 to 10.7 from 2022 to 2023, quarter end of December 31. So we can see, let's see, total revenues, 76 billion versus 86 billion. So a nice, pretty nice increase. Year over year is like 9%, right? Yeah. So, and then we get into, let's see, quarter end, other bets, alphabet level activities. So something that I noticed on their earnings call is management. Well, let's say management, you can't tell if it's actually like people talking or if it's like AI just kind of, reading a script. It's very, 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 very scripted. A lot of times they are not giving the information that investors necessarily want, and they'll tell you to call IR if you if you want specific details on things, which is kind of sad. So it does seem like at least in the valuation multiples that the market has kind of discounted Google, I would say, maybe compared to competitors, and part of that discount could be from the lack of trust in management. That's what I would kind of speculate potentially. So if we go to their 10 or no, the 10K is out, and we can kind of see just what we went over before reiterated. And this is kind of where we see that net income growth of about 23%. I did not see any guidance. I didn't hear any guidance. I didn't hear any guidance for Q1 2024. I didn't hear any guidance for full year 2024, which I don't think the market really knows what to do with that. Like their guidance was basically like, oh yeah, we're going to spend more. Like our CapEx is going to grow, which like, duh. But the way that they're messaging these things just hasn't been very good. So it's kind of interesting. If you guys know their guidance or know where their guidance is, let me know. Because I looked for it, I couldn't find it. I didn't hear it on the call. So it's pretty dang strange. Now, the thing that I would also note is that Google Cloud has also been growing at a very, very, very nice rate. And when we looked at the bottom line incomes for the different or the operating net operating income or operating margins for the different segments, we can see now that Google Cloud is actually profitable on operating basis. So let's see, where was that at? Anyway, you guys might have to take my word for it. So the bad thing about doing live streams, if you don't have everything lined up perfectly, you can't pause and go find it. So let's see, operating income. There we go. And quarter end. There we go. Yeah, so Google services operating income 2022 is 20 versus 26 in 2023, but Google Cloud, we can see, was a loss in 2022 of 186 million versus a operating income gain of 864 million, and their margins on an operating income basis for Google Cloud were right around 9%. So Google Cloud is one of those segments of the business that is starting to just like, you know, reach the cusp of profitability. And once those things turn, I think they could probably get into operating margins closer to, what probably not as good as Azure or AWS, what they will be, but towards that area. So they can probably grow their operating margins in their cloud services to around, I would say, 20 to 30%. So Google Cloud, at the rate that it's going, at the rate that it's growing, it's also expanding margins. And Google Cloud is probably going to be one of the segments that's going to lead to a decent amount of net income growth and bottom line income growth for Google over time. So I'm personally the most bullish on Google Cloud and YouTube for the business segments of Google. Search, you know what? Search, I think, it's a part of the business that has matured, right? So while I think search is going to continue to grow, it's not going to be that 20% growth. I think search is going to, die down to maybe 6-9% growth. And then it's going to be really up to how do they manage their capital and that reinvestment into the other segments of the business to grow those other segments of the business and get that to a point where those, YouTube services and cloud are generating a heftier and heftier percentage of overall revenue and income for the company. So, it was an interesting earnings. I don't think it was a disappointment on the numbers side. I'm not sure if the market just, didn't really care, was ready to sell it off because, reverse dinosaur double top. But I do think the market did have some issues with just the lack of clarity from management in the earnings call. And that's something that, management might be doing the right thing. In the end, they might be making the right decisions for the business, allocating capital correctly, investing the right amount of capital. But if they're not communicating that to investors and Wall Street in a way that analysts can trust them, then in the short term, if they don't have that trust and they don't have that clarity, then we're probably not going to get a huge as good of a premium or multiple applied to Google that we would have on like a Microsoft or Apple or whatever else, right? So, and now, I kind of see that with Meta. Meta was trash for a long time, and the market didn't really agree with the capital expenditure plan that they had, even though most of it was for CSP. And now the market's kind of turning around and coming around to it. And at the same time, Zuckerberg has has taken favorable stances as far as what market participants would want to see from a CEO. So he's all about like being lean and efficient. And I feel like we're starting to see some of that premium reapplied to Meta. So what I am really interested to see with Google going forward is if we see a pullback in the core business of search, that could inject a lot of like fear and unknowns, and the market could overly discount it because of that. That's kind of what I'm looking for. If the market overly discounts, let's say theoretically we see a slowdown in search growth, there becomes some question as far as like their moat around search and how much of a growth runway search is going to be long term. But the underlying the other segments of the business like YouTube and cloud are still growing at very, very good rates and are still at really, really good profit margins and are accounting for more and more of the bottom line profitability. I think that's a situation where we could potentially get into an oversold, like like the core, like the search portion of the business gets oversold to a point where it's like you're not really counting for the tailwinds in the other business segments. So we'll see what happens with that. When we look at, let's see, when we look at just their overall financials, go to the income statement and whoop, here we go. Yay, pretty graphs, you know. I mean, yeah, you guys can see this anywhere, but I will do it because I typically do it in my analysis. So I'll show off the pretty graphs. We've got, you know, up and to the right, pretty nice balance sheet. I mean, they have some debt, not a ton of debts, about 25 billion in long-term debt. Around 12 billion of that, or almost half of that, is in long-term capital lease obligations. So their actual debt minus capital lease obligations is probably going to be about 12 billion-ish, and they have a decent amount of cash on hand, around what 110 billion in cash and short-term investments. So yeah, I mean, they're flush with cash. They're not hurting, that's for sure. Goodwill, we can see goodwill intangibles increase slowly, and they had a increase in goodwill in 2022. I'm not sure what that was from off the top of my head. Let me know if you know. And let's see, go over here. Let's go over to free cash flow statement. Operating cash flow, free cash flow. We can see free cash flow has tanked in Q4, and that was one of the things where their operating income, their well, not even their operating income, but their net income looked fairly good in Q4. Free cash flow looked pretty dang bad. I need to dig into that more, but if that was just an increase in CapEx spend, and we've seen this with like Meta and Azure and other CSPs, but if it was a drastic increase in CapEx spend, then that can kind of have offsetting effects to your free cash flow for short periods of time while you're doing those DC build outs, or you're investing that capital. Let's see here. Stock-based compensation up and to the right pretty steadily. The common stock repurchase, I don't think this has actually populated for my spreadsheet yet, but they did repurchase a decent amount of shares, and I think they even say that in the announcement. Let's see here. Repurchase of stock was about 15.4 billion, it looks like. Is that for, no, that's 2022. So for the quarter in 2023, 16.19 billion in repurchase of stock. So and if we look at shares outstanding, let's see if we can find that. Shares out. Shares. Dun, dun. Okay, shares outstanding went from year-over-year basis. It went from about let's see, 12.8. Is that billion? I'm guessing billion. 12.8 billion to about 12.4 billion. So a decent amount of share repurchases. Just has not hit my spreadsheet yet. So, and we said what, 16, I think 16 billion, right? So 16 billion. And that basically keeps in line with the amount of capital that they've been pushing towards repurchases. And I don't necessarily I don't necessarily have an issue with them doing repurchases right now. It's not like their stock is crazy expensive, but it's not super cheap either. But they also have a really, really strong cash balance. So it's like, you don't want to reinvest just to reinvest into, additional DCs or CapEx spend if you don't think you're going to get the return on it. So I'm not totally against their buyback strategy, but it would be nice to maybe see them be a little bit more structured, or at least have the ability to really ramp up our buybacks if we do get into more attractive areas. Now, when they were on that pullback, right? When they were on that pullback on, let's see, so that would be probably around March 2023. So September Q3 2022 to Q2 2023. Let's see what they did there as far as buybacks. Let's go there. And 2022, 1, 2, 3. They did a good amount of buybacks. So they were doing a steady amount of buybacks through that entire dip, which obviously allowed them to repurchase more shares. So yeah, pretty dang good there. And we can probably even see that in ratios and metrics, I'm guessing. If we go to, let's see here, where are we at? Where are we at? If we go to buyback, common stock buyback repurchases right here. Yeah, so we can see in that time frame, on a quarterly basis, they were buying back almost, over 1% of their market cap. And then obviously as the stock has gone up, they're purchasing less. But let's see, this quarter right here, they purchased back about 1.35% of their market cap just in one quarter. So their buyback strategy, I don't necessarily have anything like super against it. But I don't know. We'll see. We'll see how they could be doing a lot worse. We'll put it this way. They could be doing a lot worse because it could be. I mean, imagine if their stock went down to that like $80-$90 mark and they didn't have they like, I don't know, didn't have capital to actually repurchase, or the business wasn't in a place where they could repurchase. So at least they were able to take advantage of that and repurchase shares when they were in that $80-$90 mark. So let's go ahead. We're going to get into the valuation now. And before we do that, I'm going to look at I don't know, I'll pull this up because why not? Analyst forecasts, and we can see revenue growth for the 2024. The consensus is about 14.13% on an average for 2024 revenue growth, and it goes into about 10.6, 10.4, 9.62. 7.6. So as far as 2024 through 2028, probably, starting out at 14 if they actually hit that. But analysts are estimating probably right around like 10 to 12% revenue growth. EPS growth is a different story. EPS growth. Now, this is also going to take into account the share repurchases, right? So we assume if they're buying back 3% of their float per year, well, you have a 14.1% right here. But then if you do 3% buybacks, you're right at around that, 18% mark or so. So 18.6% EPS growth in 2024 is the average consensus. Then we go to 15.2, 15.9, 16.06, and 23. I don't know why that's so. That doesn't make sense. What are they doing there? Yeah, the revenue, the revenue prediction is really low, but the EPS is really high for 2028. And I actually looked at this after I did the analysis. So let's go to my analysis right now, and I'll kind of explain this a little bit. Let's go through some of the high level details here. I mean, obviously we can see, revenue growth, net income growth, operating income growth, EBIT growth, free cash flow growth. You see margins. We've had margins kind of dip from about 60% into this round, 56% as of 2024. Around the lows were probably around 53.5%. So we recovered a little bit from the lows. And like I said, we have those different business segments that are starting to become more profitable, right? So we have more profitability in like cloud compute. And if we do see that margin expansion along with, I think they're growing around 30%. So if they continue to grow at, 20 to 30%, right? 20 to 30%, and they see their operating margins go from about 9% to 25, like 20, 30%. That could be a really, really nice tailwind for maybe a little bit of bottom line margin expansion here. Let's see. So bottom line yields, and this is where we really get into how the market has been valuing their cash flows over time. And bottom line yields, we can see that they've kind of ranged between a low free cash flow yield of 1.75, but we should probably go off of the EBIT yield, because free cash flow yield of 1.75, this could have been through just a cycle of increased CapEx and reinvestment, like pulling out plants, whatnot, DCs. So as far as EBIT goes, on an EBIT yield basis, they're kind of been around like 3.75 to 6 or so. And also, yeah, shares outstanding going down. So 2022, 2023. So pretty nice buybacks over the last like couple of years, and it looks like they're going to keep that up. Yeah, common stock repurchases like that. Whew, dang. So they have a large amount of their net income is basically just common stock repurchases. That's almost identical. 2022, they almost took their entire net income and repurchased shares. Okay, yeah, not bad. Not a bad year to do it, right? Not a bad year to do it. So let's go up here and we can see on a dilution / buyback basis over the last 5 years, we've got about 1.7. Let's see, what year is this? So this is 2020. So in 2020, they bought back net buybacks of about 1.7%. Then 2021 was 1.93%. 2022, 2022 was about 2.17%. 2023 was 3.13%. So they are buying back a solid amount of shares for sure. Definitely buying back a solid amount of shares. So we get into the valuation, and I have a base CAGR target of 17.5% with a margin of safety 2.5%. So target rate's about 20% CAGR, which is pretty dang high, especially for what I would consider a very solid long-term business. You could bump that down if you want to, but I'm going to leave it. And then we're targeting buybacks in the range of about 2% buybacks in scenario 5, about 4% buybacks in scenario 1. And the idea here is that, like, obviously, if scenario 1 plays out, they're going to have a lower multiple. Like, they're going to have a higher cash flow yield to their market, so they'll be able to buy a higher percentage basis. So about 2 to 4% in buybacks. Bottom line growth, scenario 1's 9.61%. That would be pretty bad, right? Like 9.61%. I mean, that would be like oh man, like top line growth is bad. And they don't have bottom line margin expansion. So that's a pretty rough scenario. And scenario 2, 11.58% bottom line growth. And then we have 13.95% bottom line growth. Scenario 3, scenario 4 would be 16.8. Scenario 5 would be 20, which that would be definitely a good scenario. And then on the multiples the market would give them, scenario 1 would be 6%, 6.07% multiple. Yield multiple. Scenario 2 would be 5.11% yield multiple. Scenario 3 would be 4.31% yield multiple. Scenario 4 would be 3.63, and scenario 5 would be 3.06. So what that kind of gives us, it gives us probably a current fair target or fair value range anywhere between maybe like 100 to 165, I would say, on a forward-looking basis. I think we're hitting like pretty much the base scenario on a current basis right now, 141, and we're sitting at 142 right now. So pretty much, I would say like around fair value. The buy prices in if these scenarios were to play out would be about $75 in scenario 1 would be the buy price to achieve that 20% CAGR. Really low probability that happens, right? In my opinion. Scenario 2 is going to be about $93 buy price to achieve that CAGR. Scenario 3, and that's going to be probably my solid highest probability base case, is going to be $120 to achieve that 20% CAGR. Scenario 4, 157. Scenario 5, 211. So and that gives us 5-year targets of scenario of one of the 195. 5-year target for scenario 2 is 245. Scenario 3 is 313. Scenario 4 is 410. And scenario 5 is 551 for these various cases. So yeah, that's what we got. That's what we got. And I think that pretty much concludes the standard evaluation section of the live stream. So let's go and let's check out some comments. As always, I hope you guys are having a great day, great week, and whatnot. And who we got? We got okay. Let's see. Hey man, how's it going? Which Discord? I'm on multiple Discords, right? So my Discord, Capital Mindset, that's usually where I'm hanging out, Capital Mindset and my Discord. So Stone Cold Investors Discord. Like and subscribe if you enjoyed the video, by the way, everyone. And yeah, Discord, Stone Cold Investor Discord link in the description below, along with financial modeling prep discount codes, which I use them for all of my automation of these tool sets, right? So like all of this is automated. If you guys didn't know, I can just pop in Microsoft right here. It'll go out to financial modeling prep, it'll hit their API, and it'll query everything. And then I am good to run and go, right? And I can look at pretty much their historical financials. I can run a valuation on them. Can look at the 5-year chart and whatnot. So it's pretty powerful. It's pretty fun. I like it. It saves me a lot of time. It saves me a ton of time, right? So yeah, I'm all about efficiencies, right? Hey Dex, how's it going? How you doing, man? Oh man, let's see. Hey, how do you pronounce that? Dedal? I don't know. Dedal. I'm doing good, man. I'm doing good. It's been a good week. I went for a hike today, man. Went for well, not really a hike. It was like a longer walk up a mountain. Well, yeah, so kind of a hike. maybe like 2 miles, 3 miles, something like that. So it's pretty fun. Took one of the dogs out that we're watching, and had a pretty good time. And also did some shopping. I found another really good bourbon I'm going to try tonight. That'll be fun. Let's see. What's this? Stockman told me all cash must be reinvested in CapEx because unlimited growth and dividends are bad. And buybacks are also bad for shareholders. So basically, just any way you can't win. Any way you can't win. Oh man, that's funny. That's funny. All right. Well, hey, if you guys don't have any more questions, it's been good. I'm glad you guys joined. I will stall for like 20-30 seconds. If you have any more questions or anything, go ahead and put them in the comments and I'll get to them. Other than that, I think we're going to wrap up here. It's been it's been a good one. I'm really interested in Google potentially over the next, I don't know, over the next year. We'll see what happens. We'll see, you know, if the perception of management gets worse and they see some weakening in their core business in that search business, then we could get into some interesting momentum to the downside, I think. You know, I pretty much have like I have a good position built out already. My cost base is around $100. So my ad point is really around that 120. And then, you know, I would consider allocating more capital at 120 and allocating more capital heavier if we got down at that $80 mark. Let's see. All right, Gil. Do you guys agree VT is equivalent to a negative leverage SPY VTI? What do you mean by that? What do you mean by negative leverage SPY VTI, right? I'm not sure what you're meaning by that. Now, I mean, VT in general, right? VT in general, like you're obviously chopping off a decent amount of your US exposure and your large cap US exposure for that international exposure. So your drag or your outperformance, if you hold VT, is going to really directly correlate to how those two segments perform, right? Like if US large cap tech performs well and international drags like you know, SPY and VTI are gonna do much better than VT. Vice versa, if we go through some type of you know, I don't know, some type of cyclical change and international stocks get a better premium assigned to them, and we go through some, growth internationally and US large cap kind of gets shoved to the side, then VT is going to outperform VTI and SPY. So yeah. Well, okay. I think whoops. Negative. Okay, so it's yeah, okay. I see what you're saying. Basically, buying SPY with negative leverage will really negative leverage is the international junk dragging it. Yeah, it's adding. I mean, you're buying everything in the world, right? So you're just adding everything just for the sake of diversification. It doesn't mean the quality is actually going to be better, right? So, but I don't know. Yeah, I mean, VTI or VT is truly just a one fund for worldwide exposure. Yeah, I mean, it's super simple. I personally, I'm confident in the US companies and the US markets and the US political and regulatory structure. And yeah, that's where I put my money is VTI and SPY over VT personally. So let's see. More questions. All right. Okay, how much is EM down now on the Nvidia short? All right, man. So last time I checked, end of close Friday, the 1 day change for his his short that I've theoretically mapped out was about 960,000 in 1 day. He was down. And I believe it was about, let's go. Oh man, let's see here. It was about 9.5 million total. So around 9.5 million total, that's a lot, right? That's a lot. So, and that's kind of a conservative estimate, man. Like if he established that short in January and then had to roll them from the June to the December expiries, he'd be down 20 mil. It's just insane. Like to naked short that is just so insane. I just do not understand at all. Dude, he might already be out. I really don't know. I hope he's out for his own sake, his family's sake. That's a lot. That's a lot of money. I mean, if it goes to 1,000, he's going to be down for sure 15, 20 mil. Like for sure, unless he hedged the position somehow. So, man, yeah, I don't know. I would hope that his family has forced him to liquidate it or has forced him to put some type of additional exposure on to hedge the short, essentially, right? Because yeah, that's really, really, really rough. Let's see. See, for that to happen, every single international country LMPD. Not necessarily, right? Because you could have pockets of international company or international stocks that could drastically outperform, and you could have a little bit of a skew balance. But yeah, like on average, a lot of them would have to outperform the U.S. markets. And yeah, I don't know. I don't know how likely that is to happen. Here's the thing that I would say is the most likely reason for VT to outperform VTI or SPY, because you can't say it's because of international revenues. I just don't think that's a valid argument, because VTI and SPY, these are companies with international revenues. If you own SPY or VTI, you have exposure to companies that have massive amounts of exposure to international revenue streams, right? Last time I checked, I think it's about 40 to 44% of revenues within SPY came from international sources, right? So it's not like we don't have international exposure. It's that our international exposure is through US based companies that are really operate under the US markets and the US regulatory structure, which I'm totally fine with. I prefer that personally, but yeah, that's me. So getting to to my answer to this, I think the most likely reason that VT would outperform VTI or SPY long term is not that international economies grow quicker, because we're going to get, like, the US companies are going to get their fair share of that revenue, right? I think the most likely way that VT outperforms VTI or SPY would be that there is a perception or a shift in the equity markets between US and international, and international equity markets start getting assigned a better premium to their equity market. And investors have more confidence in the international equity markets, and we start to bump up or reduce the premium that we're assigning to the risk premium that we're assigning to international markets. I think that would be probably the way that long term international could see, really, as far as international stock prices, could see really long term tailwinds compared to the US. But that would have to happen for multiple equity markets on like looking internationally. You have to apply to multiple equity markets, right? So it's yeah. But hey, if you just want to hold the world, that's great. It's great. Just buy VT, hold the world. You don't have to worry about any of what's going to happen. You just get to essentially be okay with taking your share of what the world equity markets produce. So yeah. Let's see. Oh man, I'm getting I'm getting behind on all these favorite. Okay. So do you have a favorite ETF or mutual fund, Jesse? I personally really like VTI. That's kind of my go-to. So if I can get VTI or a VTI equivalent, which is basically just the Vanguard, like a total US stock market. You can think of it as like the S&P 500, like around 85 or 90% of VTI is basically just the S&P 500. And then it adds small and mid cap exposure as well. So the S&P 500 obviously has 500 companies. VTI has about 4,000, right? Around 4,200 or something like that. So, but what you're really getting is, when you're buying VTI, last time I checked, you're getting about 80% or no, 85, 90% is just directly SPY. And then you're adding in about 10 to 15% of small cap and mid cap companies. Looking into large cap growth index funds. Yeah. I mean, yeah, you can do large cap growth. Like, yeah. I mean, there's so many ways to slice and dice this stuff, right? You can, I'm coming to the conclusion of, like, I just want to keep it simple. Like, I'm going to hold one index, and then, I have my individual stock portfolio where I make, I try to make highly educated not guesses, but selections on what I think might do well. So, and because of that, my individual stock portfolio is kind of my growth portfolio. That's kind of what it's coming down to. I feel like a blend of QQQ, SPG, SCHD is powerful. Yeah, I think you're. So SPGP. I don't know what that one is. Isn't there SCHG too? Isn't SCHG the Schwab like growth ETF, and D is the dividend ETF? I think Dan does like a SCHG and SCHD split, and that's a pretty good split, honestly, if you're looking for kind of growth tilt and then dividend tilt. Very little over. Man, you guys are on it. QQQ is basically SPY on steroids. I mean, okay, it doesn't get rid of the junk, right? It gets really, really heavy. Well, let's look at this. I don't know if I've shared this before, but so I have an index breakdown chart, and hey, look at QQQ is right there, right? So we can. It's just heavily concentrated in tech. So I mean, when it comes QQQ about 9% Microsoft, 9% Apple. And then you have a decent amount of Amazon, like 5% Amazon, 5% Nvidia. Broadcom is AVGO, I believe. Then you have Meta 4.16, which Meta, yeah, let's go. Tesla, Google, Costco. I think it's, yeah. I mean, it could be. It depends on your opinion of certain companies in here. Like there are certain companies I think are really good. There are certain companies that I think are really good and could be very, very overpriced, and I'm concerned about that. When we look at this compared to like a SPY, right? Just on the top like 10 holdings, put SPY in there, and we should. I'll go ahead and hide your comment. Is it going to? I might have to capitalize it. SPY, or I might have to use VOO or go SPY. So, and then SPY, we have 7.3% Microsoft, 6.5% Apple, which, oh man, Apple is no longer the king in the indexes, guys. If this is right, Apple's no longer the king. Oh man. So Nvidia about 4%, Amazon 3.7, Meta 2.5, Google 2 and 2 or so, BRKB, right? So Berkshire, you wouldn't have Berkshire if you own QQQ. Avago, there's going to be a lot of overlap, right? There's going to be a lot of overlap between QQQ and SPY, but you're going to probably remove a lot of, I think, do you remove the financial sectors in QQQ? It's going to be way, way, way heavier tech leaning, right? And then you look at something like VTI and VTI, and you'll see that the top holdings are, kind of similar. Apple's still the top in VTI. Maybe they just haven't pulled the rebalance data yet. So Apple is about 7, Microsoft 6.8, and then you have Amazon 3.4, 2.8, 2, 1.92, or 1.6. So it really depends. It depends on what type of exposure you want, right? Personally, I do think that small caps have a tendency to outperform large caps in certain environments and in certain timeframes. So I just like having, basically everything in it. So, oh, look at that Pan W, Palo Alto Networks. There we go. Oh, I wonder, does QQQ have Palo Alto? Do they? If the Qs have Palo Alto, maybe I should just buy the Qs, man. Just buy the Qs. Splunk. WBA? What? The Qs have Walgreens? No. Oh, the Qs do have FT&T though. Oh, bullish Qs. Bullish Qs. Oh man. Oh man. All right. I think that is probably gonna be it. We're going about 47, 48 minutes. So yeah, we're gonna cut it. But hey, good discussion, fun stuff. And I hope you guys enjoy it. And we'll see you on the next one. Later.